Usually, when a massive technology giant announces, record-breaking historic profits, you expect its stock to just skyrocket. I mean, that's just basic market gravity, right?
That is exactly what you'd expect.
But overnight, Samsung did exactly that. They posted these incredible numbers, and then boom, their stock plummeted 8%. And today, we are going to explain the terrifying global math behind why that happened. So, welcome to today's deep dive.
Yeah, thanks for having me. It really is a fascinating morning.
It is. I mean, for you listening, it is Monday, August 3, 2026. And you are waking up to a financial landscape that has just been radically altered over a single weekend.
Radically altered is the right way to put it. We're looking at a classic tug of war playing out across the globe right now.
A tug of war? How so?
Well, on one end of the rope, we have this immense geopolitical relief, which is acting as a massive disinflationary shock and driving Western equities up. But then, pulling hard in the exact opposite direction, we have a raw mechanical currency intervention.
Which is dragging everything down.
Exactly. It's triggering a total volatility vortex in Asian tech. So our mission today is to show you exactly how these massive global levers, things happening in Tokyo, Tehran, and Washington, how they connect directly to the tech and industrial stocks sitting in your personal portfolio.
Okay, let's unpack this. Starting with that geopolitical shockwave. So over the weekend, the news broke that President Trump officially pivoted from a planned military strike to resuming peace talks with Iran.
Right.
Now, obviously, purely looking at this as a market catalyst, devoid of any politics whatsoever, the reaction was immediate, and I mean violent, particularly in the energy sector.
Oh, it was a textbook volatility crush. I mean, within 90 minutes of the announcement, we saw a massive repricing of global risk.
90 minutes? That's incredibly fast.
Yeah, the algorithms do not wait around. Brent crude dropped 4.9% down to $83.62 a barrel, and WTI crude, that fell 5.8% to $79.72.
Wow.
We just haven't seen a sudden drop of that magnitude in months.
And obviously, if you are holding energy stocks right now, you are feeling that pain immediately. I mean, look at Cosmos Energy.
Yeah, that's a great example.
Right. They just posted a solid beat on their Q2 estimates. And typically, you beat your estimates, your stock goes up. That's how it works.
Normally, yes.
But today, they are being dragged straight down by this macro undertow. It doesn't even matter what their earnings were.
Exactly. But, flip the map and look at Europe. That pain in the energy sector, it translates to absolute jubilation for them.
Because they're importing all that energy.
Right. The DAX in Germany is up 1.2% this morning. The CAC 40 in France is up 1.0%. And when you look at the specific companies leading that surge, it's all travel, leisure, and car makers.
Because oil is the baseline input cost for almost everything in those industries.
Completely.
So when crude drops nearly 6% in an hour and a half, it basically acts like an immediate massive tax cut for industrial and consumer businesses in Europe. It just frees up their operating capital instantly.
What's fascinating here is that this drop doesn't just help European car makers. It fundamentally alters the global economic narrative.
How so?
Well, think about the Federal Reserve in the U.S. They have been agonizing over this soft landing narrative, right? Just trying to figure out if inflation is truly cooling down enough to cut interest rates.
Right, the higher for longer debate.
Exactly. So a 5% wipeout in crude prices, that is a massive disinflationary bullet.
But wait, let me push back on this a little bit. If peace talks fall apart tomorrow, which, let's be honest, geopolitics can reverse on a Tuesday.
Easily.
Doesn't oil just spike right back up? I mean, how can the Federal Reserve base its long-term interest rate trajectory on a weekend political headline that might be, completely temporary? Are investors getting way ahead of themselves, pricing in world peace on a Monday morning?
That is the exact right question to ask. And, well, the short answer is that the Fed doesn't trade the headline. They trade the data that follows.
Okay. But the market is reacting today.
Right, because the market anticipates that data. If energy costs stay suppressed even for a month or two, headline inflation drops mechanically.
Ah, I see.
So the market is pricing in the reality that the Fed simply cannot ignore a commodity drop of this magnitude. It forces their hand, it gives them the breathing room they desperately need to signal lower interest rates.
Which brings us to the second massive force colliding with our markets today, because that breathing room on inflation and the expectation of shifting U.S. interest rates is directly tied to a historic coordinated action happening overseas.
Yes, the yen.
Right. We are talking about a literal currency earthquake in the Japanese yen.
This is where the mechanics of global finance get incredibly real. like the U.S. Treasury, acting through the New York Fed and the Bank of Japan, are currently executing this massive, coordinated intervention to prop up the Japanese yen.
And we haven't seen that in a while, right?
We have not seen these two central banks team up on a scale like this since the 1990s.
Wow. And when we say intervention, I don't want to gloss over what that actually means. How do they physically do this? Do they just put out a press release and declare the yen is worth more?
Oh, not at all. They have to use brute financial force in the open market.
Brute force. I like that. So they're actually trading.
Heavily. To make the yen more valuable, the Bank of Japan and the New York Fed are taking massive reserves of U.S. dollars and just dumping them onto the open market while aggressively buying up yen.
Okay, so supply and demand. They are artificially restricting the supply of yen while flooding the market with dollars.
Exactly. And as a result, the USD to JPY exchange rate has plummeted below 156.00.
And this action is triggering something called a carry trade unwind. Now, for you listening, if you don't spend your days deep in Forex trading, carry trade can sound like really intimidating jargon.
It definitely can.
But think of it this way. Borrowing yen to buy U.S. tech stocks is like using a low-interest credit card to fund a high-yield savings account.
That is a great way to picture it.
Right. For years, it was basically free money, until suddenly the bank demands you pay off the card today.
That analogy hits the nail on the head. Because interest rates in Japan were practically zero for years. So massive institutional hedge funds would borrow billions in yen for almost nothing.
Right, because there's no penalty.
Exactly. Then they would convert that yen to U.S. dollars and just buy high-growth U.S. tech stocks, and they pocket the massive difference in yield.
The spread.
Right. The whole system works beautifully as long as two things remain true. First, the yen stays cheap, and second, U.S. tech keeps going up.
But now, because of this intervention we're talking about, the yen is suddenly getting much more expensive. The bank is demanding payment on that credit card, and the balance just went up.
Considerably.
So how much danger does this actually pose to the U.S. markets? Are we looking at a minor blip, or is this a structural crisis for tech?
It poses a severe immediate danger, simply because the brutal mechanics of an unwind. The Fed and the Bank of Japan are finally on the exact same side of this trade, right?
Yeah.
They both want the yen stabilized.
Right. So if that 156 exchange level breaks further, say it heads toward 155 or lower, the underlying math on the carry trade completely disintegrates. The trade is effectively dead for this quarter.
Because the funds realize they are suddenly losing money on the currency exchange faster than they are making it on their tech stocks?
Exactly. And hedge funds don't politely walk to the exit when they are losing billions, right? They sprint.
They panic sell.
Yeah. To pay back those yen loans, they desperately need U.S. dollars. And how do they get dollars? They are forced to aggressively sell off their U.S. tech stocks. We're talking specifically about high-beta NASDAQ names.
Okay, let's define that really quickly. Beta just means how much a stock moves compared to the overall market, right?
Correct.
So high beta tech stocks are the ones that swing the hardest. They're the Ferraris of the stock market. Fast but incredibly volatile.
Exactly. And the terrifying part of a forced liquidation is that fundamentals no longer matter.
Because they just need the cash. Right. It does not matter if that high beta U.S. tech company has a great balance sheet or this revolutionary new product. The stock gets sold aggressively simply because the hedge fund holding it desperately needs cash to cover their currency losses in Japan.
Okay, so if this massive carry trade is aggressively unwinding and funds are being forced to sell to cover their positions, we should be seeing the first cracks appearing in the Asian markets right now.
Oh, we are?
Yeah, looking at the tape this morning, we absolutely are. The divergence in Asia is stark.
It is a bloodbath in very specific sectors. First, you have the Nikkei 225 in Japan falling 1.9%.
Which makes sense.
Yeah. A surging yen is historically terrible news for their exporters like Toyota or Sony. It instantly makes Japanese goods more expensive for the rest of the world to buy.
But a 1.9% drop in Japan is nothing compared to the absolute meltdown we saw in South Korea overnight. I mean, the KSPI index dropped 5.1%.
It was brutal.
And when we look at who is dragging that index down, it brings us right back to our opening hook. It's the semiconductor giants. Samsung tumbled 8%, SK Hynix fell 7.8%.
And the phrase being thrown around trading desks this morning to explain this is AI valuation fatigue.
Okay, here's where it gets really interesting and where I want you to explain the disconnect for our listeners. Because, as I mentioned at the top of the show, Samsung and SK Hynix just posted record earnings.
They did.
They are literally making more money than ever before. Their fundamentals, on paper, look fantastic. So why are their stocks getting completely routed?
This is where we have to look at how growth multiples break down when capital costs shift.
Okay, break that down.
For the last 2 years, investors were perfectly happy to pay sky-high multiples for a company's potential. They were buying the dream of what artificial intelligence would generate 5 or 10 years down the line.
Right, the hype cycle.
Yeah. They priced these semiconductor companies for absolute perfection.
They were pricing in future dominance. But now, because of the carry trade unwind and the shifting interest rates, capital is suddenly more expensive and just harder to come by.
And that causes a profound psychological shift in the market. The tolerance for waiting has evaporated almost overnight.
They want results now.
The market is aggressively demanding proven margins right now, today. If a semiconductor company says, hey, we will make billions on AI eventually, the market is saying, not good enough, show me the cash today.
Wow.
Even if your current earnings are a record high, if the growth multiple attached to those earnings is deemed too expensive by a risk-averse market, your stock will crash.
It's like buying a house in a wildly hot real estate market.
Oh, that's a good comparison.
Right, like you might gladly overpay by $100,000 because you just assume the value will keep going up forever. But the second mortgage rates shift and the market cools, you realize you're stuck holding a massively overpriced asset, even if it's a beautiful house.
That perfectly illustrates the concept of valuation fatigue. And we saw this exact psychology play out in real time in Tokyo overnight with Kioxia Holdings.
Yes, I saw that.
Their chart is a perfect case study for this new market reality.
It was an incredibly wild V-shaped session. Kioxia tumbled 4% right out of the gate, getting swept up in that exact same semiconductor panic. But then management made an announcement and the stock completely reversed course, closing up 5.7%.
And notice what they didn't announce.
What's that?
They didn't announce a futuristic AI chip. They didn't announce some theoretical 10-year partnership.
No, they announced an 800 billion yen stock buyback, which is roughly 5.1 billion US dollars, along with a 3-for-1 stock split.
Exactly. They offered immediate, tangible, undeniable financial engineering that benefits the shareholder today.
Cash in hand.
Right. They didn't promise future AI dominance. They literally just handed cash value back to the investors. In a market suffering from AI valuation fatigue, that is the only language buyers want to hear. Proven immediate returns over speculative future growth.
So we have this intense fear of overvalued tech sweeping through Asia, driven by the currency unwind and this AI fatigue. But then we look back across the ocean to U.S. shores, and it is a completely different reality.
It really is night and day.
While Asia is dealing with a tech hangover, U.S. futures are actually climbing on a wave of industrial optimism.
It's a remarkable rotation of capital. The money bleeding out of the Asian carry trade is looking for a new, safer home, and it's finding it in domestic U.S. equities.
Yeah, the S&P 500 futures are up 0.51%, sitting at 7,528, trending right back toward that 7,620 all-time high. But the real story is that it's not the mega cap tech leading the way.
No, it's not.
The Russell 2000, the index that tracks smaller, domestically focused U.S. companies, is leading the pack. It's up 0.85% as the 10-year Treasury yield slides.
Which tells us that the de-escalation trade we talked about at the top of the show, the cheaper oil, is actively overpowering the Asian volatility vortex when it comes to U.S. industrial.
The tug of war.
Exactly.
Yeah.
Lower interest rates and cheaper oil are just the perfect cocktail for domestic manufacturing and small gaps.
And nothing proves that capital rotation, quite like the sudden explosion we're seeing in industrial mergers and acquisitions today, real money is moving in massive blocks.
Yeah, the M&A tape is lit up this morning.
At core, a major electrical manufacturer is up a massive 26% pre-market because they are in advanced buyout talks with Italy's Prysmian. We also have Steadfast Group up 4.5% on a $5.4 billion takeover offer, and Vistry Group up 6.5%.
When you see multiple multi-billion-dollar buyouts happening simultaneously in the industrial sector, it sends a very clear structural message to the broader market.
So what does this all mean for you, listening right now? Is this M&A boom the real signal? Does a company like Prysmian laying down billions for an acquisition prove that the cost of capital has finally stabilized despite all the currency chaos happening in Japan?
If we connect this to the bigger picture, it absolutely validates that theory. Industrial consolidation is officially back.
Because they aren't scared of the rates anymore.
Exactly. Corporate boardrooms do not approve multi-billion-dollar acquisitions unless they feel extremely confident about the stability of their borrowing costs over the next 5 to 10 years. The fact that European and American industrial giants are shaking hands on these mega deals tells us they believe the worst of the inflationary and interest rate shocks are finally behind us.
They're basically looking past the daily noise of the yen and placing massive structural bets on the underlying economy.
They are. However, as investors, we have to verify that boardroom confidence with actual economic data.
Right, trust but verify.
And that is why today's U.S. macro releases are so incredibly critical to watch. We have the ISM manufacturing PMI coming out this morning.
Let's define that quickly, too. The Purchasing Managers Index. Why is this the definitive gauge for the soft landing?
Because it surveys the actual purchasing managers at major corporations about their new orders, inventory levels, and employment. It's a leading indicator.
So it tells us what's happening next month, not last month.
Exactly. If the PMI is strong, it means these companies are actively buying materials to build things next month. If it's weak, they are bracing for a slowdown.
But you mentioned in your notes that the real hidden landmine to watch for today isn't the PMI, it's the loan officer survey. Why is that?
Because while M&A activity suggests money is flowing freely at the billionaire corporate level, the loan officer survey tells us what the banks are actually doing on the ground for everyone else.
The Main Street check.
Right. You want to make sure that credit conditions aren't secretly tightening beneath this veneer of optimism. If banks are quietly making it harder for average mid-sized businesses to get loans, that industrial optimism could dry up very quickly, regardless of what the stock market is doing today.
That makes total sense. We have to make sure the credit pipes are actually open. And while the industrials and small caps are having their moment in the sun today, we cannot forget that the U.S. tech sector still has to face its own reckoning. We are calling it the hangover test.
Yeah, U.S. tech stocks are absolutely not immune to the AI valuation fatigue we just saw throughout the Asian markets. The math applies here too.
We have Palantir reporting their earnings after the market closes today, and the expectations baked into their stock price are just astronomical. The market is looking for them to raise guidance above their current 71% growth forecast.
Which raises a really important question about realistic expectations.
How high is too high?
Right. If you are priced for 71% growth, and you deliver a perfectly respectable 70% growth in this current psychological environment, you might get punished severely. The margin for error is essentially zero.
We also have Snap and Vertex reporting after the bell, and both of those names are highly sensitive to that situational awareness hedge fund liquidation news that rattled the markets late last week.
We should probably clarify what happened there because it directly impacts how Snap and Vertex might trade today.
Right. What exactly was that situational awareness liquidation? Because it sounded terrifying in the headlines, but the mechanics were a bit muddy.
So, situational awareness was a massive hedge fund that made a highly leveraged bet on the macro environment. When the market moved against them, they received a margin call from their brokers.
Meaning they had to come up with cash instantly.
Instantly. They were forced to liquidate, meaning aggressively sell off massive blocks of shares in companies like Snap and Vertex.
So they didn't sell Snap because Snap is a bad company or because their earnings were poor. They sold it simply because the fund desperately needed cash to cover their bad bets elsewhere.
Exactly. It creates a localized crater in the stock price that has nothing to do with the company's actual fundamentals.
Ah, okay.
So today, when Snap and Vertex report, the market will be watching closely to see if those companies can prove their underlying businesses are strong enough to climb out of the crater created by that forced hedge fund selling.
They are walking a tightrope. I mean, it is a market that is demanding absolute perfection from tech. And as we saw with Samsung and Seoul overnight, even perfection sometimes isn't enough to prevent a massive sell-off.
To pull all of these massive threads together for you, we are looking at an incredible historic push and pull this morning.
The ultimate tug of war.
Yes. On one side, you have the geopolitical relief of peace talks dropping oil prices like a stone. That acts as a disinflationary shock, giving the Fed room to breathe and sparking a massive U.S. M&A boom as borrowing costs look stable for industrials.
And violently fighting against that, you have a historic currency intervention by the US and Japan. They are dumping dollars and buying yen, which is forcibly unwinding the yen carry trade.
Which is chaos for tech.
Right. That unwind is forcing hedge funds to liquidate their US tech holdings, causing a ripple effect that is shaking the foundations of Asian semiconductor valuations and bringing AI fatigue to the forefront.
So for you, the listener, navigating your own investments this week, it is vital to recognize that this isn't just institutional noise.
This affects everyone.
We are seeing a real-time mechanical rotation of capital. The market is suddenly willing to pay a premium for tangible industrial consolidation while simultaneously punishing tech companies that rely on speculative AI multiples. This tug of war will directly impact the balance of your personal portfolio.
You really have to look at your holdings and ask yourself, am I holding proven margins that generate cash today, or am I holding potential futures that rely on cheap capital?
And that brings us to the ultimate test of this new reality. I have a lingering thought for you to chew on as you watch the market tape today.
Let's hear it.
We have spent this deep dive watching Asian tech stumble hard on valuation fatigue. But tomorrow, SpaceX makes its massive, highly anticipated debut quarterly report as a public company.
Oh, wow. The timing on that is just incredible.
And the mechanical pressure there is going to be intense. We are looking at 911 million SpaceX shares unlocking on Thursday.
911 million.
That is a staggering amount of insider equity suddenly free to be sold on the open market.
So here's the question you have to ask yourself as we wrap up today. What happens when this massive tidal wave of new insider supply hits a tech market that, as of this morning, is suddenly terrified of AI and tech valuation fatigue?
It's a huge unknown.
Does the market blindly absorb those 911 million shares because, hey, it's SpaceX and everyone wants a piece of the future? Or does the gravity of this new risk-averse macro environment pull it down?
It is the classic irresistible force meeting the immovable object. The ultimate test of whether the market will still pay for the future or demand the cash now.
It really is. Remember, usually we track one storm at a time, but today the global compass is spinning. Keep digging into those tech earnings, keep questioning those growth multiples, stay curious, and keep connecting the dots between these global events and your own portfolio. We will be right here to help you unpack it all tomorrow. Thanks for diving deep with us today.